Did you know you can be paid in life insurance? It's true, and it's a technique that is often used by some of the top coaches in college sports. The technique we are talking about is called a split dollar plan, and it is growing in popularity with employers and executives who want to accumulate more money for the future. In simple terms, a split dollar plan is a contract between two or more parties to split the ownership and benefits of a cash value life insurance policy. These plans are used by companies to attract and retain key employees while helping those participants save more for retirement or assist in estate planning. Something that is key for many other executive benefit arrangements is that split dollar plans are often used with business owners as well as top talent. A split dollar plan can involve either an employer-owned or an employee-owned cash value life insurance policy that benefits both the company and the employee or owner. Every split dollar plan must involve two or more parties who share the cost and benefits of an insurance policy, with the plans able to be customized in the following respects: which party pays the premium, which party owns the policy, which party designates the beneficiaries, how the death benefit and cash values are split, and finally, when and under what circumstances the agreement terminates. All of these details must be described in the contract establishing the split dollar plan. There are two main types of ownership agreements between the companies and employees in split dollar arrangements: economic benefit and loan regime. First, economic benefit. When the company owns and pays the premiums on the life insurance policy in a split dollar plan, but the employee executive and his or her beneficiaries obtain some of the benefits. Such benefits are assigned to the employee through an endorsement agreement. The term economic benefit refers to the way that the Internal Revenue Service taxes the split dollar plan. The death benefit to be received by the owner or employee is taxed on an annual basis as compensation. This amount is generally the pure term insurance cost, usually quite low until older ages. In a loan regime plan, employee executive owns the cash value life insurance policy under the contract, but the company pays the premiums and obtains a portion of the policy benefits. The employee assigns such benefits to the company under a collateral assignment agreement. The IRS treats the premiums paid by the company as an annual interest-free loan to the employee, and the company's share of the policy benefits is treated as repayment to the loan. The employee pays tax on the interest that would have been charged if the contract was a traditional loan arrangement. Loan regime contracts potentially have greater tax benefits for the employee because the employee is not taxed on the value of the split dollar plan's policy benefits. However, in a period of rising interest rates, the loan cost can be expensive. When loan rates rise, it may be wise for a collateral assignment split dollar plan to use economic benefit treatment instead of a loan regime. One particularly powerful use of split dollar arrangements is in a nonprofit setting. You may have seen stories about Michigan football coach Jim Harbaugh and how split dollar plan was part of his record-setting compensation package back in 2017. However, these plans can be useful to an assortment of nonprofit organizations, including hospitals, charities, and universities. Why is that? A split dollar plan offers the nonprofit a way to address the IRS's excise tax on highly compensated employees. This excise tax levies a 21% penalty to the nonprofit on compensation, including most non-qualified distributions, of over $1 million for its top 5 paid executives. Split dollar plan loans are not subject to the excise tax, leading a greater number of nonprofits to adopt split dollar strategies. Depending on the structure, the cash value life insurance policy can provide future income and/or income tax-free death benefit to nonprofit officers and the key employees. This, combined with the tax savings, make an attractive option for nonprofit organizations. Whether a nonprofit or for-profit, split dollar plans have benefits for both the employer and the employee. For an employer, potential benefits include the employer selecting who receives benefits, when they receive them, and how much they receive. Fewer limits or rules than traditional qualified plans. low startup and administrative cost, the chance to recover a company's cost when the participant quits, retires, or dies. On the flip side of that equation, for an employee, potential benefits include the employer paying the premiums for their life insurance, employee having flexibility in the plan design to meet their individual needs, employee may be receiving tax-free income through partial withdrawals and loans, employee may be receiving income tax-free death benefits for use in his personal estate plan. Regardless of the tax election of the employer, split dollar plans universally have advantages for key employees. Either for-profit or non-profit employer treats the premium loans as a receivable or treats the economic benefit as compensation. For owners, though, the structure of the business matters. First, let's look at C corporations. The most attractive benefit of a split dollar plan is that it allows a company to leverage their C Corp tax rate to grow funds for themselves personally. Rather than the premiums being taxed at their ordinary income tax rate, the premiums are taxed at only 21%. The owner receives all the gains on the cash value life insurance policy with no tax consequences. When the plan is growing or active, the corporation can access or recapture funds from the policy if needed, an ideal plan for any business owner who has a C Corp that has retained earnings. For owners of an S Corp, they must use after-tax dollars to fund their split dollar plans, so immediate tax benefits are not as great as those for C corporations. Further, a split dollar plan is benefiting the sole shareholder of an S Corp, who is also an employee of the corporation, viewed as a compensation arrangement, with any economic benefit taxable as ordinary income and not as tax-free S Corp distribution. In today's labor market, companies are turning to executive benefit programs, including split dollar plans, to recruit, retain, reward, and retire key talent. The financial professionals with the Cowart Group provide tailored financial solutions to families and businesses that count on our experience and dedication to their success. Our aim to deliver quality advice derives from our relationships with insurers, our underwriting programs, and technology resources. We provide strategies and solutions to design to assist our clients in benefiting from and optimizing existing and changing government regulations.